Hi, welcome to our channel. Have you ever wondered what mutual fund is best for you? Today, I'll talk about 6 key concepts that helped me to pick a mutual fund for myself and hope can help you too. Before we dive into it, I need to be clear that I'm not a financial advisor. I'm just sharing my own experience and knowledge. And also, I would like to send a special thanks to my lovely wife who got me this very cool microphone. I'm super excited. Now, let's get into it. What's a mutual fund? A mutual fund is basically a pool of money managed by a professional money manager who is responsible to allocate these funds to different investment products according to the fund's investment policy statements. Concept number 1, time horizon. Time horizon means how long you're planning to hold this investment. It is very important because it helps you determine your risk tolerance. Risk tolerance means the amount of risk that you're willing and are able to take. The longer the time horizon, the higher your risk tolerance. Higher risk tolerance allows you to make riskier investments and increase your expected return. Remember, when it comes to investing, make time your friend, not your enemy. Concept number 2, financial goals. It's very important to understand your financial goals before buying anything. Try to avoid any products that do not match with your goal. Your financial goal dictates what kind of mutual fund you should buy. For example, if you're saving for retirement, which means that you're not going to need this money for a very long time, then you can buy equity-focused mutual fund because you care more about capital growth. If you need your investment to generate stable income, then you should probably choose a mutual fund with fixed income allocation and gives a stable distribution. Many investors blindly chase high expected return or to beat the market, but in my opinion, your financial goal is much more important than potential returns. Always place your goal before potential return. Concept number 3, management fee. You need to understand that every mutual fund has a different management fee structure. Management fee, aka management expense ratio or MER, will directly impact your investment return. Doesn't matter how well or how poorly your mutual fund performs, the manager of your mutual fund will charge you a fixed percentage on your total invested capital. So remember to ask your financial advisor about MER before buying the fund. Concept number 4, active share. Active share measures the percentage of holding in the mutual fund that differs from the benchmark index. For example, an S&P 500 index should have a near zero active share since the fund is basically replicating the S&P 500 index. It measures how active the fund is managed. It can also help you to justify whether the MER being charged is reasonable or not. The more actively managed the fund is, the higher MER. For example, if an index fund charges a MER more than 1.5%, it's ridiculous. Because it is just replicating the index, there isn't any part of the fund that's being actively managed. Try to avoid any mutual fund that has a low active share but still charges a high MER. Concept number 5, Sharpe ratio. Sharpe ratio measures the risk-adjusted return of your investment. You can think of risk as your cost and return as your reward. Sharpe ratio tells how much excess return that you are getting over the risk-free return for every dollar that you spend on buying this investment. The higher the Sharpe ratio, the higher value that you're getting for your dollars. This is the formula to calculate Sharpe ratio. You don't need to memorize it, but your financial advisor should know it and understand it by heart. Concept number 6, past performance. Past performance does not reflect future performance. I repeat, past performance does not reflect your future performance. Past performance only gives you something to refer to, but it does not tell you anything about how the mutual fund is going to perform in the future. It is flawed to use past performance to predict future performance, because any correlation between assets can be broken. It is more reliable to understand the volatility of your investment based on historical data rather than returns. Please do not fall into this trap when someone tries to sell you a mutual fund based on its historical return. To summarize, before buying a mutual fund, you need to ask yourself, what is your time horizon on this investment? And what goals are you trying to achieve? Once you have these answers, then you can go to your financial advisor and let them recommend you some mutual funds that satisfy your needs. While your financial advisor is going through the fund facts, you need to ask him or her the following 3 questions about each fund that he or she is recommending. First, what is the management fee? Second, what is the active share percentage on this fund? Third, what is the Sharpe ratio of this fund? If your financial advisor does not know the answers to these questions, you might want to consider looking for extra help or switching. If you have any questions on this topic or have anything that you want us to talk about in our future videos, please leave a comment down below. If you enjoyed our videos, please subscribe and smash the like button. You can also follow us on Twitter or visit our website at www.ironhawkresearch.com. We'll be posting weekly market commentary and article about things that you might want to know in finance. Thank you very much for watching and see you next time.